this.
Okay, well, thank you very much for this final two sessions. This one is on capital, and I'm going to introduce my gross output statistic as a way of measuring capital in terms of a very broad definition of business spending. I wanted to mention one other thing, by the way, for people who afterwards would like to look at my book, Vienna and Chicago. This is the one where I was talking about the personalities and so forth. And you can see the picture of Mises and Hayek here, very serious looking. And then you have the two Chicago economists, Milton Friedman and George Steger, both smiling. And I did this on purpose because the Austrians tend to be more sober and pessimistic. Although they did call Murray Rothbard the happy warrior, so he's definitely smiled a lot more than the others. I also have a picture. I'll have to send you. I have a picture of Milton Friedman smiling and laughing with Ludwig von Mises together, and of course it's a fake photo. I put them together, but I fooled a lot of people. I said, where did you get that? I can't believe you have a picture, because Mises and Hayek, Mises and Friedman never had a picture together. So I created one with the idea of the bridge between the Austrian school and the Chicago school coming together instead of splitting apart. And they definitely, one of the major differences between the Chicago school and the Austrian is on capital theory. But that's a different topic for sure. So let's talk about what I regard as the greatest economist is Carl Menger. So I am just delighted that Darren has chosen the Menger Institute. And why is Carl Menger the greatest economist? Because he was the first economist to get microeconomics and macroeconomics right. Macroeconomics in terms of subjective marginal value. Subjective marginal value determines price and cost and values, okay? That was a breakthrough. And the second one is the stages of production, the structure, time structure of the economy is the correct macro point of view. And I have charts on both of those. So there's some really great quotes from a variety of people about, I don't know if you've seen all these before, but it's quite an endorsement of Menger as a brilliant analyst, and one that changed the minds of all of these great people, including the Keynesian economist, Sir John Hicks. And we've got Jesus Huerta de Soto that says some nice things about of course, he considers Mises the greatest economist, but Mises was a student of Menger, so why not go to the original source? Okay, so the Grundsatz was now translated, actually not translated into English until 1950. Can you believe that? 1950. I mean, Eugen von Böhm-Bawerk's theories of capital and interest were published in English in 1890. Menger's student. So these are my accolades. I wrote a paper called Carl Menger, the Greatest Economist, for this festschrift that we did for Jesus Huerta de Soto a couple years ago. So here's a little background on Menger. I don't know if you've done this for any of the students too, but it would be valuable, I think, on your website to just list, you have all this PowerPoint, and just list the background on so people know who Carl Menger is. Okay. So here's how I use Menger in my own teaching of economics. The first thing is, I talked about this yesterday, comparing average wages as the standard way of measuring standard of living. It's deceptively wrong. But nevertheless, that's what it does. Now, what would Menger do? Well, Menger would focus on quantity, quality, and variety of goods and services. As opposed, were you all here yesterday? Were you here yesterday?
I wasn't here yesterday.
Okay, you weren't. Okay. So this is a kind of complex chart here, but it shows you in the United States since 1900, when did the average household get electricity, telephone, air conditioning, internet, washer, dryer, refrigerator, microwave, radio, TV, color TV, VCR, cell phones, and you can see there have been dramatic improvement, even though average real wages have not grown since 1972. Look at all of the household items that are now available. So demonstrates that Menger viewed, he didn't like the idea of just one single statistic to measure standard of living like real wages. He preferred quantity, quality, and variety of services, Q, Q, and V. Okay? And when you see it that way, you see a dramatic improvement from everybody's standard of living. Also, prices are determined at the margin. This was a great breakthrough that he discovered when he was a journalist, when Menger was a journalist for the Viennese newspaper, and he was covering the stock market. And he found out that prices were determined not by any relationship to cost of value, but it's related to the number of buyers and sellers. Marginal number of buyers and sellers. What determines the price of a stock? It's not all the owners of the stock. It's the day the stock is traded. It's the volume, liquidity that determines prices. And he discovered this and said, oh my gosh, this is where Adam Smith went astray. And he introduced the marginal principle, and he used tobacco, which is a great modern day example. He said, what if people stop smoking? What happens to the value of cigarettes? Well, they go to zero, unless they have another use, an alternative use. And as a cigarette, it doesn't. Now, as tobacco, it might have an alternative use, but as a cigarette, it would go to zero. But what about farmland that produces tobacco? Would the farmland go to zero? No, because the farm can be used to produce soybeans, that can produce wheat or corn, or can be made into condominiums. So it's the best alternative use. So marginal, maybe it would decline a little bit, but it's not going to decline by very much. So it's marginal. That's what determines prices at the margin. So there's this Eric Streisler, who was a professor of economics for many years at Chicago, probably the most Austrian of the. He was also a Keynesian, unfortunately, but Streisler, as he called himself, he said, when I met him, he said, no, it's Eric Streisler. He really emphasized the S. But he's an interesting guy. So he says Mengerian goods are three-dimensional. They have quantity, quality, and variety, with separate dimensions of dynamic change. And Lionel Robbins is saying the same thing about choice, quantity, quality. Pretty interesting, these views regarding Menger's economics. So I like to use the example of the Babe Ruth card, Babe Ruth signed baseball. What determines, often you hear, well, they're not making any more of these, right? Babe Ruth is dead. You only signed 100,000 baseballs. So therefore, the supply is perfectly inelastic. So can the price go down? Well, only if demand goes down. But actually what happens is, that this is the reality. The reality is that if the price goes up for baseball cards, or baseballs, signed Babe Ruth baseballs, more Babe Ruth baseballs are going to become available for sale. So you see an increase in the supply, all right? So it's only inelastic when you reach the maximum, 100,000, and it never reaches that. So the supply curve is actually can be quite elastic. And then there's the theory of imputation. And he used the example of tobacco, which is a very modern day example. And I like this statement from Roger Garrison. We have a reader here who can read this. Okay, go ahead.
The direction of causation was reversed by Menger. A consumption good is not valued because of the labor and other means of production that were used to produce it. Rather, the means of production are valued because of the prospective value of the consumption goods.
So you reverse the trend. I mean, this is revolutionary in that respect, that the final consumer demand determines what the price is of inputs as well as outputs on the production process. And then finally we come to the general theory of the good. And this is where I wrote my book, The Structure of Production. This was published in 1990 by NYU Press. And if you look in the dedication page, I dedicated to Carl Menger. And he talks about the general theory of the good, connection between goods, the structure of production in the production of goods. So the focus of economics is on goods and services as the primary purpose of business, to produce goods and services that people can actually use. Okay? So there's a hierarchy of goods. He talked about the high order goods and the low order goods. And we don't use those terms today. We say earlier stage of production and later stage of production. Or in the case of oil, we talk about upstream, midstream, and downstream. Have you ever heard these terms before, referring to the production of oil? So upstream is you're discovering oil. Midstream is the pipelines, putting oil through the pipelines and to the refineries, and then to the final stage of production is the gasoline, the use of gasoline or kerosene or the final product, which is downstream. So you hear these terms all the time. Well, this is very Austrian. This is very Mengerian. And John Hicks made the really important observation. He says the Austrian model of the economy, of stages of production, is, in essence, the businessman's perspective, the merchant's perspective. And so this is why economics has gone astray, as I will show in a lot of the charts and so forth, because we've removed economics, we have made economics different than the businessman's perspective. But the Austrians got it right, mainly because Menger worked in business and realized that we need to move in this direction. And even Adam Smith has certain elements of the stages of production approach. When he talks about the division of labor and the production of pins and how pins need to be produced. He has 18 stages to produce a pin sold to people who sew and so forth, the pin users. It's all in Adam Smith, as they say. So I use the example of the production process of wheat turning into bread. I use a 4-stage model of the economy. This doesn't really work, does it? It works down here, but not when it gets on this part, so I'll just point to it. 4-stage model of the economy. You add value at each stage. I'm using Hayekian stages of production approach here in prices and production. Prices and production was a real advance because he created diagrams to describe what Carl Menger talked about in higher order and lower order goods and that sort of thing. And von Böhm-Bawerk did it too and so forth, but when Hayek did this in prices and production, and nobody knows for sure where he got it, probably from Jevons. Jevons seemed to do some of this. He made a real breakthrough here by doing this. So I've imitated this. You can't you have the theory of the stages of production in Hayek's Prices and Production, came out in 1931. But I created the four-stage model of the economy so that you would understand, put real flesh on the bones that Hayek created. See, this is Hayek stuff. See, it's all theory. He never applied it to real-world data. Never did. It was just pure theory. That was one of the reasons that I fault him. I don't fault him that much. I fault his next generation of not creating, actually putting numbers to it. Even Rothbard, Man, Economy, and State, it keeps it at a purely theoretical level. And so what I've tried to do is put flesh on the bones and to link the data. So what you'll see here is a linking of the data with government statistics that are being compiled on the four stages of production. We have real numbers for the United States. So this is Roger Garrison. Again, Garrison's purely, his time and money is purely theoretical. No data. No data at all. And Austrians, up until recently, have been afraid of putting in data because of the potential distortions that you can get with it. Chicago school was way ahead of the Austrian school in that respect. How do you test a theory? You look for data. And of course, Mises' response was, well, you can't prove anything with data. But maybe you can confirm certain things with data. And actually, Murray Rothbard, I give real credit to Murray for his America's Great Depression book. He puts real data in to prove that the 1920s sowed the seeds of the Depression. That's what he did. And so he disagreed with Mises on this point, and I give credit to Murray. He was absolutely right. Now, there was a big argument over the data that he used, but still, I think he did a great thing by doing that. So here is my halfway point to give an idea of how to use Mengerian, Hayekian stages of production that students get. So $5 for a cup of coffee at Starbucks, maybe out of date already, might be up to $8 now with inflation. But let's go with $5, okay? Then you have the four stages. See the four stages? Starts with the coffee and the raw coffee grower, the farmer who grows the coffee, sells the 1 cup of coffee. He sells the beans for $1. The $1 then go to the roaster, the producer, the manufacturer of coffee, takes those beans and roasts them and then packages them into a package. Then the wholesaler takes that coffee and is shipping it. He takes the package and he has a shipping business that adds the shipping costs that it takes to get it to the Starbucks restaurant. And the restaurant takes these roasted and packaged coffee beans, puts it into the Starbucks machine, adds certain things to it, and sells it. So the cost was $3.50 for him. Sells it for $5, and that's his profit as $1.50. Okay. So this is a fun graph because it shows a lot of different things. One, you'll notice that if you take value added, let's take value added at the top, $1, value added second stage, $1, value added at the third stage, $1.50, at the fourth stage, $1.50. If you add this, the value added at each stage of production, what do you get? Huh?
Oh, just the value added?
Yeah.
$4.
$5.
Oh,
Essentially,
yeah.
yes.
Guess what? It's equal to the cup of coffee. Pretty cool, huh? In other words, if you add up all the profit margins at all stages of production, you end up with the gross sale price of the product. It's pretty cool. Okay, so this is my micro model. Okay, by the way, no text, well, actually there is one textbook that has this. And that is, John Taylor has a textbook on micro.
Yeah.
What they don't have, no other textbook has this, except my own textbook, which I brought a copy of, Economic Logic, okay? So I have the micro model of Starbucks, and then in my macro model chapter, I have this. This is the macro model. Notice the similarity between the micro model and the macro model.
I found the page right away.
Yeah, good. Well, you're fast. Okay, so every product goes through these stages of production, right? Goes through resource stage, then it's produced, and then it's distributed, and then it's the final output, okay? And notice what's really cool about this is you can integrate the Austrian model, the Austrian stages of production with current national income accounting, because your end result is GDP. So I'm not telling you to replace GDP with my statistic, which is gross output. What is gross output? Is 1 plus 2 plus 3 plus 4. It's adding together all the cost to produce a particular product from beginning to end. How much does business have to fund to produce a cup of coffee? And if we go back to this one, you'll notice that if you add all the gross expenditures of all 4 stages, you come up with $11.50. It costs $11.50 for business to produce a $5 cup of coffee. So how does that make sense? How do you explain that? They spent $11.50 per cup of coffee to produce 1 cup of coffee. Doesn't that sound like you're losing money? Anybody want to explain that? Took me a while to figure this out. You want to know the answer? Well, you raise $11.50 per cup of coffee to produce $5 a cup of coffee, and it takes time. Anytime you invest in a business, do you get all your money back? If you invest $1 million to start a business, no, you get a profit out of that. There's a lot of expenses and costs related, and you only get maybe 10% return on your capital, right? So it's going to take 10 years to get your money back. So business capitalists forward the money to finance projects like coffee making and anything else, and it just takes a while to get your money back. Okay? So that's the reason for it. Okay, so this is my general model of the economy. And I believe one of the people who was here yesterday mentioned Geo. I don't think he's here. Yeah. And what's interesting is my model of the economy means, look at, we're doing all these stages of production. I've now converted it from 4 stages to a triangle. This is called Hayek's triangles. So this is the production process. This is the make economy. And then GDP represents final output. And then it starts losing value. Why? It's called the use economy, because as you use up the finished good, it depreciates in value. And eventually it's not worth anything because it's consumed, totally consumed. And food is your best example that food consumes pretty quickly. It may take a little bit longer to consume a cell phone. Cell phone will last for 6 or 7 years, and then you get a new one, right? Or the battery in an EV. After a while, you're just going to throw it away, right? Your computer, all things are used up or lost or what have you. So this is the relationship. So this is the production process. This is the consumption process, okay? And all production leads to final consumption. So Joseph Schumpeter said, the whole of the Oregon of pure economics thus finds itself unified in light of a single principle, in a sense of which it has never been before. And this is what Menger started, Hayek continued, and Rothbard and others, and then I've tried to advance it to its highest level at this point, okay? So that the economics profession will finally recognize that this is the correct model of micro and macroeconomics. So that's my book, The Structure of Production, that introduced this. And there's an old saying that science progresses one funeral at a time. And I wrote this book in 1990. In 2014, the federal government has adopted my gross output model, which I'll explain in just a minute. So I'm happy to see science has progressed before I die. So I call this squaring the Mises circle, because I'm able to integrate Austrian economics into a standard textbook without having them tear up their textbook. That's what I tried to do with economic logic. And other textbooks are starting to adopt gross output. Okay. So what is gross output? Well, I introduce it by talking about what drives the economy. Some say it's consumer spending, like the Wall Street Journal. Some say it's the government spending that drives the economy. Some say it is business that drives the economy. This is Barack Obama saying small business is the engine of economic growth. So what is the growth of what grows in the economy? And of course, the data that everybody uses is GDP, and C plus I plus G, consumers, C, government, G, business, or I, investment. GDP shows the following. This is the latest data, and you can see consumer spending is the biggest sector in the economy, and this is what causes journalists and the media to say consumption drives the economy because it's the biggest sector. Followed by business investment, and then government spending, and then net exports, X minus M. Anybody know why you subtract imports in gross GDP? You ever wonder about that?
The money's not contained.
Huh?
Like the money leaves the country.
Right, so it measures domestic. So why don't you just measure X? Why do you subtract M? Shouldn't it just be X?
It's embedded in consumption and investment.
Right, it's because, very good, Darren, the professor knows the X, because it's already in C and I and G. Okay, so you have to subtract it out so you get domestic production. That's the
That's
reason.
an exam question.
But you know what's funny? No textbook says that, explains
I
that.
wouldn't even think most professors who are teaching, they know the answer to that question.
But they don't,
Yeah, they
it's
don't
not in the
explain.
textbook,
No,
you
it's
have to
not.
figure it out.
Yeah.
So I always ask my students, and I get this dumbfounded look like, what, I don't know. So that's the answer, good answer. So you can see why so many, the media focus on retail sales and consumer spending, because they're using GDP as the model, okay? So what's wrong with this model? Because economic growth theory all says that, that investment in the supply side drives the economy. Technology, innovation, saving, investment, capital expenditures, that's what drives an economy. Entrepreneurship, as you were talking about the other day, yesterday. So this is the GDP model. The big elephant in the room is consumer spending. So that's where you get all these people saying consumption drives the economy. And these are quotes, Wall Street Journal. Household spending generates more than 2/3 of total economic output. Spending gains should be translated into economic growth. And here is Robert Reich, who is Secretary of Labor under Bill Clinton. Consumer spending accounts for 70% of the U.S. economy. This unleashed consumer spending generates more growth. Okay? And this is from the Wall Street Journal. So it doesn't matter where your source is, they're all saying the same thing: consumer spending drives the economy. Okay, I'm going to go to what's missing from GDP. So the problem is with GDP itself. And here's the problem. So GDP is C plus I plus G. We're going to kind of ignore net exports at this point, $30 trillion. It amounts to CIG. C is the big factor. What's missing? The supply chain. They don't measure the supply chain. They measure only. So in terms of production, it's just final production. It's that last stage, the four-stage model of the economy that I showed you earlier. GDP is just the fourth stage. It leaves out all three previous stages. When you include it, look at the amount. $32.3 trillion. GDP itself is 30 trillion. So the supply chain is even bigger than GDP. That is a major omission. That is what we call a sin of omission, big time. And it does make a big difference as to what drives the economy. Okay, so the new approach is called gross output. And what is gross output? If we go back to this graph, number 4 is GDP. What is gross output? Gross output is resources plus production plus distribution gives you plus final output. It measures spending at all stages of production. And going back here in the micro model, it's the $11.50 that you're measuring. Okay? You're measuring all of the spending at all stages of production. So what I call top line and bottom line national income accounting. So how many have taken accounting? Any of you taken accounting? So what's top line in the financial statement? You ever heard this term, top line financial statement? It's used on CNBC, all the financial people use it. You hear it sometimes in accounting, but not a lot. So what is top line in a financial statement? What is the top line?
Revenue, the money that came in.
Revenue and sales, or sales, exactly. What's the bottom line?
Profits.
Net income or profit, right? So I'm saying economists need to catch up with the accounting and finance professions. And we need a top line and a bottom line in national income accounting. What is the top line? Total spending at the entire economy. Business has to raise a ton of money to spend that money throughout the economy. What's the bottom line? GDP. GDP is the finished product. That's the bottom line. You finished product, that's how much it is. But to ignore all those stages, all the supply chain, is a big mistake because they move separately. They don't always move together. Just like in financial statements, is sales and earnings always increasing or decreasing by the same amount? Can you increase sales and still lose money in a company? You bet you can. That can happen. Your sales didn't, because costs went up even more, you lost money. That can happen. So you ask yourself the question, well, maybe the supply chain moves differently than final output, and we'll see that that's often the case. So I've come up with this idea of top line and bottom line national income accounting. And no textbook does it yet. Still waiting. It's just forever. Peter Drucker once said, economists are the slowest learners. This is, you mentioned Austrian economics being a school of thought, fewer and fewer people adopt it. But this is practical, good, sound advice. And I meet with the BEA that produces gross output and GDP. And I'll talk to you in a minute about a meeting with them on Friday, and I'll talk to you about one of the reasons that GO isn't as well known. So there's my triumph. So on April 2014, the BEA, which produces GDP, came out with a new statistic called gross output that measures high-X triangles, spanning at all stages of production. And so this is a quote from Stephen Landfeld, who's the creative, you said creative person who came up with the government. This restored my faith in government, by the way. They were willing to measure high-X triangles, measure the supply chain and add it in. So, Steve Landfeld says this. You want to read that quote from Steve Landfeld?
Gross output provides an important new perspective on the economy and a powerful new set of tools of analysis, one that is closer to the way many businesses see themselves.
Exactly, okay. And what's interesting is the BEA even defines GDP in terms of gross output. Want to read this?
Real gross domestic product, the value of the goods and services produced by the nation's economy, GO, less the value of the goods and services used up in production.
That's II. Intermediate inputs, or the supply chain is II.
Adjusted for price changes. Increased at an annual rate of 0.5% in the first quarter of 2016, according to the advanced estimate released by the Bureau of Economic Analysis. In the fourth quarter, real GDP increased 1.4%.
So they define GDP using GO. And what they do is the BEA comes up with the benchmark gross output statistic every 5 years. And they use census data to come up with this. So they're trying to improve the quality of their data all the time. And so they just did the 5-year plan, okay? And they came up with the gross output. And out of the gross output, they produced GDP. So GO is the top line. GDP is the bottom line. And no economists, except myself and a few others, are preaching this. It's just taking a very long time. Now, I'll tell you the reason why. Because if you go on the BEA website, bea.gov, go there right now, you cannot find gross output on their splash page, their opening page. It's not there. It's hidden under GDP by industry. You know why they did that? So I finally pulled it out of them. Why do you bury GO? You got the statistic. People don't use it, and that's because you bury it. Why don't you bring it out? And he said, well, we're afraid people will get confused. They need just one statistic to represent GDP, represent the economy, and that's GDP. Okay? So that's their argument. So even Greg Mankiw at Harvard University, a longtime friend of mine, and I said, listen, Greg, come on, let me come up, I'll give a talk at Harvard. I've spoken at many universities on this and got the support of several Nobel Prize winners on gross output. How about you should introduce this in your textbook? He has the most popular textbook right now, Principles of Economics. And he said, Mark, you don't understand. My students have a hard enough time understanding GDP. If I introduce GO, that'll make it even more complex. And I said, Greg, they're Harvard students. They can understand top line and bottom line accounting. That was my answer to him, but he didn't buy it. But really, it's not. Is it really that difficult to figure out? It's pretty simple. I don't understand, except they're slow learners. They don't want to create a new issue, a new problem. Pretty depressing in that respect. But they've asked me to meet with them on Friday. I'm kind of hopeful that maybe, see, the BEA needs to come out and say, hey, we're now going to have a top line and bottom line. We're going to play it. They do a press release of GO, but it's buried under GDP by industry, by the bottom line instead of the top line. I'm asking them to do a separate press release on GO. I mean, it's pretty simple. GDP plus II intermediate inputs, the supply chain right there equals GO. Or GDP equals GO minus the supply chain. Okay, so here's the thing that you discover with the GO. Finally, GO is I plus II. That is, it's business to business spending. You measure the supply chain plus I, which is private investment. You add those two together, and you come up with over 60% of the US economy. Personal consumption is still very important, but it's only a third, it's not 2/3 of the economy. So you have these two models. You have the GDP model that makes consumption the big driver of the economy, or GO, business, which is more accurate. All right, so what do you learn from the GO statistic? Well, you can see here that in normal times, they kind of move up and down. Sometimes GO is higher, sometimes GDP there's not a lot of big changes. They're different. They move differently, as you can see. But look what happens during the recessions. Okay, GO dropped almost 30% in the 2008 financial crisis. How bad was the 2008 financial crisis? We came that close to 13 out of the top 14 institutions going bankrupt in America. That's what Ben Bernanke said. GDP dropped during a time period of 8% during that time period versus 30%. So the business cycle is more a function of GO. GO does a much better job. And in the pandemic period, it was very short term. It closed down the economy. And both of them fell almost by the same amount. So this is a more typical situation. Now, they only have data going back to 2005 on a quarterly basis. So we can't go back to other recessions. But generally speaking, in other recessions, GO not only collapses faster, but recovers faster also. You see that? Here, this was kind of an artificial shutdown of everything, consumption and production. But normally production is more vulnerable to a recession than consumption. Because people still have to eat, they still pay their rent and stuff like that. The other thing you learn is that business spending is twice the size of consumer spending. So what drives the economy? Business. What is the business cycle? The business cycle is here. You don't see it that much in consumer spending. You see a small dip during the recession, but you see a dramatic dip in business recessions. So the business cycle is based on business. And notice that business is twice the size of consumer spending. So what drives the economy? It's not consumer spending. Say's law says that. Say's law says consumer spending is the effect, not the cause of prosperity. So here's Larry Kudlow. Would you like to read that?
Though not 1 in 1,000 recognizes it, it is business, not consumers, that is the heart of the economy. When businesses produce profitably, they create income, paying jobs, and then consumers spend. Profitable firms also purchase new equipment because they need to modernize and update all their tools, structures, and software.
Okay, now of course businesses do need a consumer, do need the customer to buy their products, but what is the catalyst to creating new products? That's the question. So I always ask my students, is Seattle prosperous because of producers or consumers? And I point out that Boeing, Microsoft, Starbucks, Amazon, Costco, these are the major new goods and services, new companies that entered into it that made Seattle prosperous. It wasn't consumers reaching into their pocket and pulling out their credit card and spending. It was businesses coming up with new ideas that consumers wanted. They didn't know they wanted it until they produced the product. So I spent a whole classroom on that discussion. We don't have time for it, but I just wanted to show you that it's production, it's entrepreneurship, it's innovation, it's new technology that drives an economy. And what country is best at that?
The United States.
The United States, because all the biggest companies in the world are US based. Amazon, Microsoft, Apple, Costco, I don't know if they're international or not, but Facebook and so on, they're all based in the US. And it's created incredible envy about heart of other countries, especially Europe, that's trying to shut them down. My geostatistic also is consistent with economic growth theory. Economic growth theory does not say that retail sales or consumer spending is a leading indicator. They are not leading indicators. This demonstrates that more countries that save more and invest more, not consume more, but invest more, grow faster. And this is a great example of this. Let me see if I can. Let's look at this. U.S. Conference Board 10 leading indicators. Okay, the 10 leading indicators, if you look at those, how much of them are consumer oriented? Well, you can see it, consumer right there. You can see it number 3, consumer goods. That's at the manufacturing level, not the retail level. Consumption plays a very tiny role as a leading indicator. Everything else is supply side oriented, supply chain, including the stock market, interest rates, and so forth. So what drives the economy? This is a recent statement by an Indian economist. You want to read this part right here? Read this paragraph. Do you want to read it? Somebody else?
I can do it.
Okay.
The virtuous cycle originating from private investment is crucial for sustained economic growth in India. Investment leads to productivity gains and creation of jobs, both of which increase disposable income in the economy and thereby foster consumption. Thus, in the first round effects embedded in the virtuous cycle, private investment is most crucial for enhancing consumption. In the second round effects embedded in the virtuous cycle, anticipated increases in consumption spur further investment by the private sector.
So if you want to talk about the virtuous cycle, what drives the economy, it's investment that drives the economy that leads to higher consumption. That's what he's saying over and over again. And then if we look back at this chart, this is a wonderful chart. This is the Keynesian model where consumer spending drives the economy and savings leaks out here. It may or may not result in technological advance. There's no connection necessarily between the two. Consumer spending drives the economy. In the more modern example, you see it's investment that comes around to increasing new production through improvements, education, training, new machines, and so forth. That creates new product, and consumption is used up. See, consumption is used up here. Here, savings is draining, used up, or disappears. Here, consumption is used up. So, after making this presentation, I asked my students which one is a more accurate picture of how the economy actually works. And I actually sent this to Paul Samuelson while he was alive. So I had some correspondence with Paul Samuelson. So this is his own graph in 48. Savings drops out of the economy. Consumption drives the economy. Or is it this one? He had the honesty to admit that this is more accurate today than this is. This is a Great Depression model where if you saved, the money went under a mattress or went into the bank and it was idle resources. So anyway, it's a very, very powerful example of this. There's a leading indicators quotes. So what's happening to government business spending right now? It's been in quite a recession, actually. Consumption's been rising, government spending's been rising, but business has been flat, if not declining, for the last 2 years. Pretty interesting. So if we have a recession this year, it may well be because business doesn't know what the heck this Trump guy is doing, especially with imposing these tariffs, which is raising costs tremendously on business right now. I saw one estimate that it's going to reduce, his terrified is they're going to reduce GDP by 0.8%, almost 1% drop off of that. So he's engaged in a high-risk gamble here to change globalization and trade. So that's my general model of the economy, to analyze the entire production process and not just final output, to analyze each stage of production, CPI, PPI, commodity price index, look at the yield curve and not just interest rates, not just the 10-year interest rate, rate of unemployment, but the structure of employment and unemployment, and stock indexes looking at various stages of production. The structure of the economy matters is my basic thesis. And this is my textbook that covers it. The others that mention gross output but don't go into as much detail, but there are a number of them that are now starting to mention GO as the top line in national income accounting. So with that, I've covered my capital investment type of concept. Any questions?
So you said the two takeaways basically from GO. I know the second one was that business spending drives
Drives the economy.
and the first one was what was the first?
You mean that savings?
Consumption.
Or
No, the first takeaway basically from incorporating the GO model. So there were in your slides there was a first takeaway that I can't remember. The second one was that business because business spending is greater.
Right, and more volatile.
And
The business cycle is
right, yeah.
is GO and B2B spending. It's the supply chain that's the real motivator. Consumer spending is relatively stable. So you can, as far as predicting where the economy is going, you can kind of ignore consumption. What you need to look at is business outlook, the outlook for business. And even the index of consumer expectations ask questions like, is your job secure? So they're actually asking a business question. The only question that consumer survey asks that's really consumption oriented, they say, are you planning a vacation over the next 6 months? That's pure consumption. But most of the time they're asking business questions. What's the outlook of your business sector industry? What about your job? Is it likely to keep your job? Stuff like that. So everything is business oriented, and really good forecasters, and a lot of people now use GO as a forecasting tool in the private sector. It's pretty interesting what's going on here. So this is a major issue. Anybody else? Yeah.
Yeah, I still don't quite understand why, because at first I thought that like all of at each stage of production, like the price is kind of embedded, which is why like 5 equals 5. But then like, and it kind of does make sense to me that there is an actual level of spending which amounts to $11.50, like in that example.
Yeah.
But I still, what I don't is you mentioned that the reason that you count this is because like they were expecting returns in the future, or they're willing to wait longer for the returns?
Right. And so at each stage of production, you're making a profit, right? In this model, the Starbucks model. You have value added at each stage, you're making a profit. But you're only paying back a small percent of your gross expenditures that you had to spend to buy goods moving through the process, your capital expenditures for your tools and equipment and your machinery. Almost all of that is capitalized with borrowed money. So there's borrowed money at every stage of production in most cases. There are some companies that have no debt, but that's because they've issued stock rather than bonds. So that's the way I look at it.
Okay,
I think maybe you're worried about the double counting.
Yeah,
Because it's been accounted for. And then the second stage, you're taking what's accounted for, and then you're adding value added when you're adding them up all, then it's 11
and a half.
and a half.
Yeah, if we,
So, yeah, I think that's what you
That's-
have in mind,
yeah.
the double counting aspect of it, how do you?
and I'm glad you brought up double counting, because this is the biggest bugaboo by economists. They don't understand business, how business works, and they simply dismiss the gross output, oh, it's just double counting. Well, notice it's moving that production. Double counting is essential. Unless you have one big firm, a monopoly firm that runs everything, you're going to have double counting at each stage of production. I believe it's $6.50 in the Starbucks example, that's all double counting. But notice the beans are changing location, or they're being transformed in there, and that needs to be done. You can't run an economy without double counting, because it involves people at each stage saying, oh, I can make a profit here by being in an intermediate stage. So I'm buying the product and moving it along the production stage, and I'm making a profit doing it. So that means double counting. While you don't want to count double counting in final output, it's still an essential aspect of business. To move that production process along, you have to have double counting. And to simply dismiss it as double counting demonstrates ignorance of how the economy actually works. Okay.
Okay, let's take a few minutes
Take
break,
a little
and then,
break.
yeah, and then we got 45 minutes.
Okay. End up with a discussion of monopoly power.